Hello, friends. So we had a wonderful day today, right? I hope all of you guys enjoyed seeing all those green lights on whatever platform you use for trading or investing. It was wonderful. For the last few days, we've been seeing all a bunch of red lights, kind of depressing, but today was awesome. So I'm going to talk a little bit about what's going on with the rate cuts. How did we get here? What do I expect? What kind of things I'm doing to protect myself from some of the risks that is emerging in the market. So I'll talk about all of that stuff. I also want to talk to you about a little bit about in terms of real estate and rate cuts as well. So we'll talk briefly about that. And then obviously I'm going to talk in more detail tomorrow on our real estate webinar. So hopefully you guys are joining us. I will send everybody who have already registered or in our database, I will send out the link for tomorrow's webinar. So you will have that easily available. And then if you join the webinar, I'm probably going to have a really cool gift for everybody who attends the webinar that we will give away during Wealth Summit. So that will be kind of interesting. This is something new I'm trying this year, and if there is enough interest, maybe that will become a tradition going forward. We'll see how it goes. So please do join me tomorrow. I'll share all of those insights with you. Now, once again, as a reminder, I'm not an investment advisor, so don't treat me as one. I just teach people how to think about finance, how to think about markets, politics. How do you spot emerging trends? How do you protect yourself? It's really all about wealth preservation. So I teach you some techniques, some systems that I have built myself that helps me, and perhaps they can help you. So I teach all of that in our coaching program. So you're welcome to join that coaching program if you. Or if you want to learn about it, by the way, I will be in Fremont tomorrow. So maybe later on in the evening, you can stop by. I'll just reach out to me, let me know. I'll let you know which hotel I'm staying at, and you're welcome to come there and we can have a nice discussion. Few other people are coming up as well, so we can all get together and talk about the wonderful world of finance. All right, so that's the plan. All right, so let's talk about rate cuts. People get super excited when they think about rate cuts. People feel like it's going to improve their life. People feel it's going to put more pocket money in their pocket. People feel that companies are going to make more money because of rate cuts. All kind of positive thoughts come into your mind when you think about rate cuts. But a couple of problems. Number one problem is rate cuts don't even influence the rates themselves. So if they don't even influence the rates, how can they possibly have an impact on anything else? So we're going to talk about that today. We'll also talk about inflation. We'll talk about the job market. So all of those things we're going to discuss. So let's start out with the basics. So about a month ago, a market says, you know what, I think rate cuts are coming. And we were pricing in the rate cuts. And then we got ourselves a job report. Didn't really look good. In July, we were expecting about 120,000 jobs, but there were only 73,000 jobs. And then we got a little bit more surprise. In May and June job numbers, we were told were actually wrong. They were revised downwards, 258,000 jobs. That was kind of scary. And then we looked at the unemployment, which didn't really change much. It was 4.1, now it's 4.2. So what the heck is going on with the job market? So let's address that first, and then we'll talk about inflation, then we'll talk about rate cuts. So I can tell you personally speaking, jobs has been softening for the entire year. And I can tell that not because of some data or some numbers, because I have been hearing that in my consultation appointments. So Sanjeev and I, we do a lot of tax consultations whole day long, helping small business owners and individuals craft interesting tax strategies that can help them save money. And we hear, hey, Deepakji, I'm going to lose my job in a couple of months, or my wife lost a job, or my son lost a job, or something like that. So we've been hearing that whole year long. My company is doing some layoffs. Things are not looking too good, both public sector and private sector. So we've been hearing this in our own practice. So we knew that job market is softening. Now, whether the numbers are right or wrong, I don't really care a whole lot about that, because I can vouch from my personal experience that numbers not looking too good. We also know that layoffs are increasing in the country as well. So we have that data. And now market is expecting that this job losses will only exceed in the coming months. So that's one data point that we do have. Then let's talk a little bit about inflation. So the CPI headline inflation is 2.7%. So no surprise there, all good. Core inflation rose from 2.9 to 3.1%. Now, 3.1%, Feds don't like that, right? What do Feds want? Anything below 2%. That's their magic number. Personally speaking, I mean, 3% is really not that bad of a number. If we can stick with 3% and have a growth of 4 or 5% in our GDP, I'm fine with that. Because, and there are reasons behind that, right? Number one reason is, let's take housing, for example. Why would housing prices go down? You tell me. I mean, people are sitting on 2.5%, 3% mortgages. Mortgages are sitting at 6.5%, 7% right now. Why would they sell? Why would they move out? Why would they buy another property? Why would they trade their house? There's no reason for them to do that, right? So, inflation. Second is insurance. We don't control the insurance. Insurance rates are set because of accidents, because of the cost of vehicles, because of risk involved. Again, unless you fix that problem, inflation is not going to go down. Then on top of that, you have a lot of demand. Demand is being created through AI. Demand is being created through because people are making more money. People want to spend money on services. Demand is being created by baby boomers who have a lot of money. I mean, think about it. Last 20, 30 years, these people made a lot of money. A lot of retirees are sitting on a lot of equity on their homes. Again, heavy spenders, creating a lot of demand, right? So as long as demand is there, why wouldn't the inflation exist? Why would somebody reduce the prices? Like if you want to reduce the prices, you need to kill the demand. You need to bring the demand down. And the way you do that is by forcing recession, which is not happening. At least I don't think Trump administration wants that. Feds don't want that. Americans don't want that. And there's a lot of reasons for that, right? Number one reason is President Trump went ahead with inflation with a promise that it's not going to put us in recession. It's going to be good for America. So I don't think he can accept that answer that because of inflation we went into recession. So that's not acceptable. Number two, we have a lot of debt. So if we get into recession, that becomes another problem, right? We need to take care of that as well. So recession is not an option right now. So now we have a balance. If you think about it, in one way, if job market is weakening, that supports the rate cut. We should have a rate cut now. Why? Because if you don't and it gets worse, it goes from 4.2% to 4.5 to 5%. Cool thing is it's not really growing that fast. It's growing slowly. The velocity is not there. But if the velocity was there, if it's like rapidly starts to increase, that can really derail the market, right? So before it gets there, we should intervene and stop it. Why? Because once it gets derailed, it's not easy to fix. It's not like you can cut the interest rate and people will start hiring again. Doesn't happen. It takes time, maybe 6 months, a year. So if you ask me, what is more worse, inflation or unemployment? It's always going to be unemployment. Inflation, you can pay for it as long as you're making money. But if you're not making money and you have inflation, that's a problem. Now, some of you guys might say, okay, so you're really saying that inflation is rising and unemployment is dropping. Isn't that a problem? Yeah, it's a problem. But if you think about it, because we have less wage growth, because we are expecting rate cuts, don't you think those two will be sufficient to offset the impact of any inflation we might have? And then don't forget, we already got the tax cuts. So add that. Now, I know some of you guys are like, well, we didn't really get a tax cut. It was just an extension. Okay, fine. But still, it's a tax cut because if you didn't get that extension, you'll be paying more taxes. And I don't think anybody will be talking about inflation then, right? So I think inflation will be there. It's going to have a small impact. It's going to make things a little bit more painful for people making $100,000 or less. But it's not going to be one-time impact, and which most likely will get offset via rate cuts and other incentives that government is making available to everyone, such as tax reductions and some of the other new incentives that we have in the big beautiful tax bill. Now we'll talk all about all of those incentives in tomorrow's webinar, so I don't want to go there. So join the webinar and we can that way you get a comprehensive understanding on that. Now, as far as we are concerned, Market is happy. Although Jerome Powell didn't say anything whatsoever about rate cuts, but he hinted that he is not opposed to it anymore. And that was good enough. People are happy that he has finally come to an agreement that we do need a rate cut, and most likely we're going to get one in September. So market is rallying. Market is happy. Take a look at stocks. Take a look at gold, silver, Bitcoin, crypto. Everything is up. I mean, some of the growth stocks went up like 8, 10% in single day. So what do we do now? Is rate cuts going to help me buy another house? Can I refinance my property? Should I borrow and buy more stocks because it's going to help the small caps, and it's going to help reduce some of the interest expense? Well, so let's talk about that for a second. Number one, let's start with the individual homes. So when you and me go try to borrow money to buy a property, the banks typically look at the 10-year treasury. And that's, we get the rate based on that. So 10-year treasury, I think last year, I think it was sitting at 3.6. And right now it's sitting at 4.24. I don't think that's going to come down. You can keep watching for September, October, see what happens. But the 10-year treasury will come down when market is confident that inflation is under control. So we might get a rate cut, but we might not be able to benefit from it just yet, which creates a problem. Well, if the rate cut is not going to impact, my financing, then why is the marketing rallying? Like, take a look at some of the home builder stocks. Why is commodities up? Why is Bitcoin up? Why are people taking on more risk? See, rate cuts are sentimental. It's emotional. What it does is it tells business owners to wait a little. It's telling the business owners that we're not going to be late. We are going to step in and do the right thing. So imagine a small business owner who is running a $5 million company or a $10 million company, and he needs to lay off maybe 10 people because he needs to finance, he needs some capital, he's worried about growth, he's worried about recession, he's worried about Trump administration policies, whatever. Like, it's whatever is on top of his mind. And then Feds come out and say, hey, wait a minute, I understand your concern, but rate cuts are coming. In matter of fact, we're going to start next month. In September, we're going to give you a rate cut. And then it's not going to be one, and usually it's never a one rate cut. When they do it, they might do one rate cut, then again the second and the third and so forth. I think market is pricing in about 2 rate cuts for this year. So now, as a small business owner, I get a little bit more confidence. I'm like, oh, I see. That means I don't have to worry so much. I don't need to let go of people. I can hold on to that staff. So what it does, it stabilizes the job market. People who were afraid to hire people before because they didn't know what the economy is going. Maybe they're worrying about recession. Maybe they're worrying about some other problem, related to inflation or whatever, right? We don't need to necessarily pinpoint the problem. I'm just saying sentimental value here. So those people are so much worried. And now all of a sudden they hear from the Fed that, hey, things are okay. We're here. We're going to back you up. We're going to step in. We're going to take care of you. Then that fear gets calmed down. And that is what you're seeing in the market right now. So when all of these prices are rising, all of a sudden overnight, well, not overnight, not night yet, still a daytime, but I expect them to probably continue to do well, maybe on Saturday, Sunday. But I think by Monday or Tuesday, we will probably start to see things calm down a little bit. That means most likely we're going to give back some of the gains that we made today. So that brings me to my most important point. Do we need to become complacent in market? No, we don't. Should we go sell our home? Should we start borrowing money on margin? Should we start doing some crazy stuff to take advantage of things because this is the start of a bull market? Absolutely not. Why? Well, because it's still August. We still have to deal with September and early October. We don't know what the other report's going to look like. Like, can you imagine if we get an unemployment report and all of a sudden that's up to like 5% or 6%? Okay, we are going to get a correction if something like that happens. You never know in the market when you might get a surprise. So being complacent in market never pays off. But I'm seeing, some of the stocks that are way far away from fundamentals are still rising today. That's not good. We're seeing people borrowing money on margin to buy some high risk growth stocks. That's not good. That's going to get in trouble, right? And then most importantly, even in real estate market, I see plenty of risk emerging. So if you want to talk about real estate, by the way, tomorrow is a great day. So I'm not going to discuss that today. We can certainly talk about it on the webinar, or just show up to meet with me in person tomorrow evening, and we can talk there as well. So that's my thoughts about the inflation and unemployment and the rate cuts. If you ask me, did the Feds do the right thing by sounding dovish? I think so. Because in the last few years, Meg 7 were able to take advantage of their massive size. Small business owners don't have access to those kind of resources. We borrow money from banks on our credit cards against our home equity. So when those rates come down, they do help us survive as a small business owner. So I do like to see the rate cuts to help an average American being able to take advantage of opportunities that are available to them. So I know some of this could be controversial. Maybe you might see, well, wait a minute, this might feed into inflation, and it will. But I think the risk of not having rate cuts is far bigger. I know so many people who are struggling. So many people who are not able to buy homes, so many people who are not able to afford the things that they want to buy. So rate cuts will help. The problem here is when these rate cuts will actually be seen by an individual. That's the real challenge. So rate cuts is a good start. It's a good sentimental start. And it's important. But we need to work on the second problem related to inflation. If we are not able to control it, I think that rate cut benefit will not going to get passed on to the individual. That's where the problem is. But hey, this is a start. We all got to start somewhere, right? So this is a start. Don't see it at the end. It's still going to be a bumpy ride. We're still going to get some hiccups along the way. But overall, we're living in the wonderful country of the United States, and I think we're going to figure it out together. So that's my plan. I'm taking it slowly every single day, following my simple strategies and just buying on a regular basis. That's all I'm doing. And things are working out great so far. And if you come to the private personal meetup, I'll be happy to share more details with you and tell you how we're doing, what are we doing, and answer any questions that you might have. Well, that's all I have for you guys today, but I'll see you tomorrow at the webinar, 10 a.m. Pacific Standard Time. We'll talk all about real estate, and then in the evening, I'll be available for a meetup. All right, guys, see you. Bye-bye.